Okay, I think we'll make a start and then people late can just filter in. We'll go through the intro so they'll not miss too much. Right, okay. So this is the second this is the second webinar that we've done in this series. It's getting a lot of really good feedback. So we're really good. We're obviously really happy to see that. And because of that, obviously we want to keep doing these. So again, at the end of the webinar, if you do have any feedback or anything else that you'd like to see, just let us know. Um, so with that in mind, let's make a start. I'm expecting this one to be a little bit more comprehensive. Now, I've tried my best not to make it too technical, but a lot of the aspects of obviously finances and controlling finances in businesses are complicated. They're things that the likes of me and Jonathan, the other partner in the firm, trained for with ACCA and have to understand these principles to get our licenses. So we've tried our best to keep it generalized for everyone. And so if there's things that don't really make too much sense, don't let that get to you. Sometimes you just need to hear it a second time, a third time, and have it maybe applied specifically to your business. So today's webinar is going to be about taking control of your business finances, like you can see. It's actually simple enough to do this. I don't want to spend any time on this webinar talking about tax rates or thresholds. The plan is going to be to keep it focused on business principles rather than tax. So if something feels relevant to your situation, use it as a prompt to check your own position. And then at that point, come and get, specific advice and then what tax implications that type of stuff has. But as we go through it, you'll understand why the tax rates aren't really relevant too much. This is more about principles. So, like I said, I'm expecting it to run a little bit longer than the last webinar, just purely by the nature of what it is. So maybe around 40 minutes. And I've have done my best to try and make it, like I said, comprehensive without being technical. But any issues, any questions, yourselves, just leave them in the chat, and I'll do my best to get through as much as possible at the end without letting it run on too long. So, I suppose what are you going to get out of this webinar? You can see it there. There's kind of three core elements. I'll do a quick rundown tonight of what the plan is. So, what me and Jonathan have noticed more and more is that most of our clients don't actually need more spreadsheets, more tax planning. They want a simple way to understand what their numbers are actually telling them and then what to do with that information. So, that seems to be what we're starting to get now, that the clients are a lot more educated on how to save tax. It seems to be now, well, what does this mean? How can I grow because of it? How can I apply it? So by the end of this session, I want, or I hope that everyone will be able to answer three questions, which is the business actually profitable? If it is profitable, why does it not feel like it's profitable sometimes? Because that's very common. And then what changes can we put in place to fix that feeling of something not being profitable when in fact it actually is? I want to cover the differences between profit, cash, and turnover because they're not the same thing, but they often get confused. What numbers we think you need to be looking at whenever you're trying to make decisions. And those will be based off our experience of what numbers we personally look at and what numbers we have our clients look at. How to price yourself based on the real costs of running a business, but more importantly, based on how much you actually want to get out of your business, because I think that's something that's always missed. And then how to actually pay yourself. So when you're in that position, you've priced everything, it's all good, it's all worked. How do you actually start to get the money out? So, like I say, a lot of this is going to be based on our personal experience. Me and Jonathan wrote this together and what we see come up the most. So, hopefully, it's all pretty applicable to our client base. So, make a note as we go, a mental note. You don't need to write this down. What are your average monthly sales and what would you like to pay yourself each month? Because a lot of this what we're going to discuss it is relevant. The core of running a business is paying yourself. We don't run a business for, the sake of it. We run a business because A, we know what we're doing and most other people don't, and that's a service that people want, but we get the freedom of doing it. And then it's about, we can make more money working for ourselves than working for someone else. But you have to understand how to get that money out of the company. Or if you're a sole trade, we'll go through that as well. Okay, you've probably heard this expression a lot. Oddly enough, we heard it this week, even though we'd already wrote this and nobody had knew we were going to throw the term in. Client did say busy but broke. You may feel as though you're working, as many hours as you physically can, but the numbers don't reflect the effort that you're putting in. Okay, and that's very common. It's usually not a motivation problem, especially not a motivation problem in our case. Uh, it's not even always a sales problem. You might be a very good salesperson. It's typically a numbers problem, is what it comes down to, and that's that your numbers aren't 100%. And that typically starts from the pricing perspective. So the usual pattern is that you're working hard, customers are buying, but the bank balance never feels safe. The bank balance doesn't seem to move up. It always seems to stay static or go down. So you don't feel like you can relax. There are typically three areas that you can see here on the slides that are the core culprits that we see. Now, it doesn't mean they're the only culprits, but they're absolutely the core culprits. And one of the three are probably applicable. And that's that your gross margin's too thin. And I would be very surprised if most people on this webinar actually look at what their gross margin rates are, because it's something that a lot of clients don't look at because they don't know the formulas for it. But they're very simple. Your overheads have been very quietly creeping up, very, very common. Cost of everything's rising. So if you're not monitoring that, you're not going to notice. And your cash timing is working against you. And what I mean by cash timing is that VAT bills come up, tax bills come up, big annual bills come up, insurances need renewed, clients pay you slow. That type of stuff all comes into your cash timing. So whilst you're invoicing out and it's all great, if no one pays you, it doesn't matter how much you invoice. So you can be profitable on paper, but loss making in reality. And it's something that obviously people want to do their best to avoid. You're not going to avoid it by not looking at it though. So I don't want people to come away from this thinking that they have to be bookkeepers or credit controllers. I want you to try and be the kind of business owners who actually spend the time to look at their numbers, even if it feels daunting. And then when you're doing that, you can obviously make good decisions and impactful decisions with what the numbers are telling you. So, I want to talk about blind spots before we get into the detail of it. Everyone has them, especially business owners. Businesses always feel so personal. Kind of five main kind of blind spots, if you want to call them. Now, most financial chaos that comes with businesses, it's not mystery. It's not like, where's this come from? Why do I feel like this? It comes from a handful of predictable areas. So you can see what the predictable areas are on the right. You've got your VAT registrations. People are obsessed with turnover. People are underpricing. People aren't paying themselves as a priority. They go, well, I'll just take what's left. So if you're VAT registered, part of what lands in your bank is VAT that you've collected for HMRC. That is not your income. I don't know how many times we've had to explain this to clients. It's not your income. It's nothing that you've earned. You're basically a glorified tax collector for HMRC, and that's money that you're just holding on their behalf. So even if you're not VAT registered, tax will build up during the year based on your profit. And if you want to wait until that bill arrives to think about it, you'll always feel like you've been ambushed. You're not going to be ready for it. So if you don't plan for it, it's always going to be unexpected and it's always going to cause pressure. So the best fix for both corporation tax, personal tax, and VAT is something that we preach all the time, which is called a tax pot. That's not the actual term for it. It's just what we've kind of coined internally. But a tax pot is essentially just a savings account within your banking system. Some people go a step further and open up like a general investment account as part of the business to try and get bigger interest rates off the money that they've set to the side. But the gist is move your money regularly into these savings accounts, especially the full 20% for the VAT. I always move the full 20%. We do it as MJK and we've always done it. And now we've started doing it a lot more for corporation tax because our corporation tax has become a lot more predictable. So every month we'll move a portion into a savings account, typically 20 or 30%. Second blind spot is turnover obsession. We see this constantly with these mentors coming out going, I'm going to throw your revenue up. You're going to build 10 grand a month. It's going to be great. Turnover to us is a very vanity approach to running a business. You can grow your turnover by taking on really low margin, high hassle work that always pays you late. and you'll actually end up being worse off. So yeah, you can go tell your friends that you do 10 grand a month, but no one's paying you and you're walking away with a grand a month. You may as well go work in Tesco because it's going to be a better take home pay. So you've got to approach running a business from a profit perspective, because that profit number is what you can then take out and what you can use in your personal lifestyle. You need to forget about the turnover. The third is underpricing. So biggest pricing mistakes come from costs that you don't feel day to day, the cost that you're not looking at, that your time, your admin, if you have to rework a project, resend that email, all your consumables, these, five, six, £7 a month subscriptions that you're not looking at, all of that. If you don't have a strong indication on what those costs are, well, then pricing is just going to be guesswork. And if you're guessing, it's always going to be inconsistent. So the fourth is paying yourself. Now, I know this is probably one of the areas that everyone's kind of come to this for because they want to understand how to pay themselves. And we will get to that towards the end. But the fourth is paying yourself. And owner pay is typically just whatever's left. So if that is the case, you're either going to underpay yourself or you're going to overdraw and cause panic later. Now, healthy businesses, from what we see on a day to day, they treat owner pay as as a planned cost of running the business, even if the legal methods differ. And by that I mean, are you going to take a salary? Are you going to take a dividend? Keeping something consistent on a monthly basis is extremely important because you have to account for this cost whenever you're pricing jobs. You can't just be pricing a job and then taking whatever profit is left after you've paid your tax. It's no way to run a business. It's no way to run a lifestyle. And then the final blind spot that we see all the time is bank balance scoreboarding. Your bank balance is not a performance metric. You need to stop using that. You need to stop saying, well, my bank balance has nothing in it, so I must have no tax bill because I've made no profit. That's not how running a business works. It's not how tax works either. So even the same concept of going, well, my bank balance is going up, so I must be profitable, I must be making money. It doesn't mean it's going up the right amount. So those are the kind of five core problems that we typically find when we speak to clients, the feedback that we get. I want to unpack a lot of that as we go. So before you fix anything, before you even look at anything, you need to separate three words that people constantly mix up. So turnover, profit, cash. Turnover is what you sell or invoice in a period. It's pretty normal. Everyone knows that. Profit is what's left after you subtract all the costs for delivering the job, the work. And then cash is when money actually arrives or leaves your bank account. And all of this matters because we can have businesses that are high turnover but very low profit. And that's typically if the direct costs are high or the time costs are high. And a business can be profitable on paper, but cash poor if customers pay late, for example, or if you buy stock up front or VAT or tax land at a very awkward time. Now, I'm a fan of examples. I think everyone who's ever spoke to me knows I like to give metaphors and examples as much as possible. But I know they're difficult to follow along on a webinar, so I'll try my best. I've put the little box on the screen. I'm sure you can see it there. We've got invoice, cost, profit. And what I'm trying to show here is we can see we've invoiced 8,000, costs were 6,000, the profit's 2. Now, in a practical view, that is actually a very profitable job. You've made 2 grand. Okay, yeah, it's cost you 6. You've billed out 8, but you've made 2 grand. That's actually a really good job. But let's say it was a few different jobs. It's not one customer. So you've billed 8 grand in the month. It's cost you 6 to run the company, and your profit's 2. If only 50% of your customers pay you, you're in theory running at a loss. The business isn't sustainable. So when we look at cash position and cash flow, you'll hear the term, obviously, cash flow is king. Everyone always says that. But it's actually extremely important. So that job's probably been priced correctly. So the turnover's fine. Profitability's there. Profit's fine. But it wasn't paid. Only 50% was paid. So we're now in a cash loss. Now, granted, the rest of the money may come in down the line, but that's where the pressures start to build up and now you're in a loss. Now you can't fund the next project. You maybe have to take a higher deposit. That might put a customer off. All these things start to compound. So you really need to be looking at everything, not just the one. So that's obviously extremely important to us. We see it all the time, causing problems. Now, the bank balance is not your profit. I kind of obviously mentioned that 2 slides ago. It's really important that you look at your bank balance as a current timing position. It will mislead you. Now, it can mislead you for a few reasons. Three reasons are timing. So you can invoice today, get paid next month. And then in terms of VAT, if you're registered, some of that cash isn't yours, like we talked about. On the top end, 20% of that is not yours. And then tax, which is based on your profit, you can spend the cash in your bank because there's a timing difference between when you pay that corporation tax bill or that personal tax bill against when you invoice out and collect the money, which is why again you want to have obviously that tax pot. But they can all cause problems. These are all things that are coming up that your bank balance isn't obviously telling you about. So your bank balance isn't reflective of it, which is why I like to move it out. So when you log into your bank, you've got a true reflection of how much cash the business has. So I have seen clients have a really good week. I've seen bank balances jump up when you got to remember I look at your 12 months on a row. So I'm seeing a whole snapshot of the year and I see your bank balance shoot up, shoot down, shoot up, shoot down. We see it constantly and it's typically because a VAT payment lifts and the next thing you know the bank balance plummets. And it's always VAT. VAT's the main culprit. I'd say it's 80% of the problems for a lot of people. The other culprits are usually like insurance renewals come in, rates renewals come in. Most people like to pay those obviously annually. We obviously account for them on a monthly, we'll spread them, but they lift annually and you're maybe not expecting it. And then the next thing you know, your bank balance is zero. When it was 100 grand yesterday, it's zero today, and you're thinking, what the hell's going on? And it's not your fault necessarily. It's that there's not been a system in place to account for that and budget for that and plan for that. And so that's something that you need to start forecasting for as much as possible. Now, when you're doing your forecasting, there's 5 core numbers you need to look at. We talked about gross margin at the start of the call. It's probably the most important, if not one. It's one of the most important, definitely. And these are what we use. When I say we, I mean MJ Kane. These are what we use as our scoreboard, and we do this monthly. So if you were to only look at these 5 lines each month, then you could probably run most micro and small businesses without needing to look at anything else. They virtually cover everything. So your turnover, obviously you want to look at what you've sold, really important. Your gross profit, which is your turnover minus the direct costs, extremely important figure. Your gross margin percentage, another really important figure. How much of each pound of sales is left after your direct cost. It's extremely important because that's what's obviously used to fund overheads in your pay. Overheads then themselves, which is the cost of keeping the business running, and then your net profit, what's left after you've paid everything except obviously tax, but you've paid everything else, so no surprises coming along, and that's what you're paying yourself out of as well. So these 5 lines will tell you whether your pricing and your delivery are healthy. So whether the business can actually support your income based on the net profit, or whether your business is just whether it's growing or you're just busy. These are the core. These are the 5 core that identify that for you. So once a month, what we do is we'll compare this month to the last month and the same month in the last year. I know that's difficult to track that timeline, but you want to take February and look at January to see what's gone up. And then you want to look at February 2026 and look at February 2025 because you want to see if you've had growth. Okay, it's better to look at growth over a 12-year period than a month-to-month period. We actually did this. Obviously, well, we had our SLT on, what is it, the 11th? We had our SLT on the 7th. And when we scoreboarded this, we actually looked at the overheads and found one of our suppliers increased the fee. Now, it was only about 50 pound a month. It was nothing in the grand scheme of what we pay our suppliers, but we noticed it. It was something so small. And we wouldn't have noticed it if we didn't have our comparisons. And we have ours obviously scoreboarded in columns. And so we noticed that we were able to pick up the phone and find out, why is it gone up? What's the reason? So really important exercise, definitely worth doing. Now, this is my favorite number. It's extremely important. So I want to zoom in on this one. Your gross margin, that's a bit corny, but your gross margin is where the truth lives. That's what we and Jonathan say. If your margin's weak, then your business can't fund anything else. It can't fund overheads, can't fund tax, can't fund paying you. So margin's really important. Your gross profit, okay, that's what's left after the direct costs of delivering the work. So that's your materials, your stocks, subcontractors, delivery, and then any job specific costs. That's your gross profit. Your gross profit margin, so your gross profit percentage, is a slice of each sale that's left to pay overheads, tax, and use. So it's a little bit more complicated. Typically, you want a gross profit margin of 60 to 70% as a baseline, where we try to aim for 70% as much as possible. And if your margin's too low, then that's actually due to the fact that you've not priced properly. So your pricing technique is wrong, or you've just not tracked costs, like your supplier costs, or maybe you've done your best to track it, 5 months ago, but it's increased obviously in the last couple of months. So I want you to remember that overheads, so the likes of rent, software, admin, they'll come after gross profit. And if you do want to work out your gross profit, I don't know who has a pen and paper, or if you've got a cracking memory, your gross profit divided by revenue times 100. So take your gross profit. So what were your sales? What were your direct costs? Divide that by the revenue, so your turnover. Multiply it by 100. That'll get you your percentage. So it's a nice, easy formula. Every business owner should know how to do this as well. Every business owner should have a main service, like a core offering. And for that core service, you always need to know what your selling price is, what your direct costs are, and what your gross profit is in pounds. If you can't answer that for at least your main offering, then I would say you need to go back and reevaluate your whole pricing model, because your core should always be sitting in there. If someone phoned me or Jonathan and said how much is it for X, we would be able to just quote it straight away. If someone asked us how much is it for Y, well, we know how much of Y is built up in X. So it's easy for us to go from kind of X to Y in a pricing category, because we know what builds up the core and how many of the core elements make up all our other service offerings. So it's really important that you've got one in your head of I need to charge X, and then whenever obviously new jobs, new products come up, it's easier to quote it. And then track gross profit for your cash awareness. It's very, very important. Overheads, another really important aspect of controlling the finances in a business is controlling the costs. I'm sure that makes sense. Overheads are a net profit killer, obviously, because they don't feel dramatic whenever you're purchasing something, because they're always so small. They're always so small, but they technically set what your minimums are to try and hit a profit. So they're your break even point. So if you don't know what your overheads are, you don't know what your break even position is. If you don't know what your break even position is, you don't know what you need to do to make a profit and pay yourself. So overheads are what you pay to keep the door open. I think that's a very good way of looking at it. It's not necessarily about the job, it's what you pay to keep the business running, keep the doors open. That's your premises, your software, phone costs, vehicle costs, insurance, marketing, professional fees, things like that, bank charges for running the bank account. Real kind of simple stuff. Bank fees could be £6 a month. You're not thinking about £6 a month when you're pricing jobs necessarily, but you need to. You need to start bringing all this in. And then they'll all come obviously after your gross profit costs. They are fundamental in setting break even. If you don't know your overhead base, to me, you can't price. Everyone needs to know it. It's very important. We reassess ours every quarter. I know I said we benchmark and scoreboard every month, but we reassess our overheads every quarter. Do we need to change suppliers? What contracts are coming up? What can we exit? What can we reduce? We do that. Small costs accumulate. I think everyone knows that. What's the saying? Count the pennies and the pounds will look after themselves. Really important that you apply it here. So once a quarter, go line by line, cancel what you don't need, renegotiate where you can, stop any costs that no longer support the business, because you'll buy something now because it makes sense. In 3 months, you might have moved on, you don't need it. So after overheads are taken off your gross profit, you're left with net profit. And your net profit, as you can see, your net profit is a very important job. It's what you use to work out what your tax bill is, and what can you pay yourself, and then how much of a buffer can you build or can you build. So VAT and tax extremely important. I would say I would confidently say 80% of the problems that we see with clients are because of VAT. Arguably, the other 20% are to do with tax, but there's always the small numbers to do with something else. But VAT is huge. It's one of the main reasons businesses fail. Now, so is tax, but it's mainly VAT. So we've got VAT, income tax, and corporation tax. Income tax, obviously, for sole traders, corporation tax for limited companies. If you're VAT registered, VAT sits in your account, it looks available, but it isn't available. Now, I know a lot of people on this call, or this webinar, sorry, are clients. So we've talked to you before about the importance of tax pots and set things to the side. There's a lot of people on the call who aren't clients. And so you'll hear me talk about tax pots constantly. I know it's just something I go on about quite a lot, but it's extremely important. So that is the fix. I know it's very boring, but the fix is to move your VAT into a pot, move your corporation tax estimates into a pot, and move your personal tax estimates into a pot. Now, I'm not saying you've got to move them in and do nothing with them. At MJKN, what we do is we've got a money market scheme set up where we'll take our tax pot, we put it into this. We typically get about 4 to 4.5% interest returned. And so at least we're having the money do something for us. Now, granted, then that money we have to pay tax on what we get. But we don't want the money just sitting idle. So if you can't use it to grow, at least use it to try and earn additional interest. And if you try to do that with the standard high street bank, you'll be lucky. What are they charging? What are you giving you at the minute? Like 1.5%. It's not worth anyone's time. You may as well set it in a pot rather than give it to them. So one of the other things with income tax, which is it's slightly harder with income tax, I find, to build a tax pot. You can do it; it's perfectly easy to do, but it is slightly harder to predict. So if you're a sole trader, you're completing self-assessment. You'll also face something called a balancing payment. I'm sure you've heard of payments on account, and so they are installments towards the next tax bill, next year's tax bill. You pay those in January and July. And I've seen it become quite stressful because people don't remember that this July payment on accounts coming. Most people pay January's because you pay it with January's bill for this year, for the year that's just passed. But most people miss July, and so it's quite a pressurized scenario that you find yourself in. Personally, I'm terrible. Actually, as an accountant, I should be good at it. I'm actually terrible at paying my July payment on account, so I now pay it all in January, which goes against what I'm saying about get your money doing something. I mean, I make no interest paying it early to HMRC, but I'm just terrible at paying it. I keep forgetting, so I pay it all in advance. But I wouldn't suggest doing that unless you're like me. I would suggest that you try and get the money doing something for you as much as you can. But I have mine just sitting there, sits as a credit, and then when the July payment comes in, needs lifted, HMRC just apply it sideways for me. So if you're running a company, it's something that's kind of similar. If you run a company, I don't want you to assume that the profit equals the cash, which is then equal to the dividends that you can take. Even if a company has cash, the dividends have to be supported by profits that are available for distribution. And again, I don't want to get too technical, but basically you're going to need up-to-date bookkeeping, very important. You need a basic sense of whether profits, actually exist before you can take a dividend. It's not just the bank looks healthy, I'm going to take 5 grand this month. Okay, you'll end up taking money which would have been earmarked for the likes of corporation tax bills, and you'll end up owing money back, okay, into the business. If you don't pay that back, then you're going to get hit with another tax bill. And there's probably a lot of people on this call don't know what an S455 is. Sounds very technical, but it's a 33.75% tax rate. So let's call it 34% for ease, okay? You're going to get hit with a 34% tax bill on top of your corporation tax on the amount of money you took out that you weren't meant to. So if you take 10 grand out and you're not meant to take that out, you're going to owe HMRC £3,400 and you've got to pay it. And you've got to pay it in line with your tax bill. And you only get that money back if you repay the full 10 within 4 years. So that again, that now all of a sudden puts you under more cash flow strain because you're out 3,400 and you've still got to find 10 grand personally to pay back. So you can very quickly just get completely out of hand, and it's something that most people don't plan for. So, bit of a rubbish slide. No one likes to talk about VAT and tax, but it's very important that you think of these things throughout the year. Set up your tax pots, 20% to the side. It better yet, if you actually have a history of, well, here's my last 4 years accounts, here's my last, 12 quarter VAT returns. Here's my last 4 years self-assessment. You could probably see a trend in how much VAT and tax you pay. And so you could just divide that by 12, set that money to the side. It might not cover it all, but if you can cover 80%, finding the other 20% is typically easier than finding 100. So one thing that we talked about at the start is going to be pricing. Okay, a lot of people price off markets. So matching the market rate is something a lot of our clients do, and we always advise against it. It's very typical with serviced accommodation, actually. They have a look at what's on Airbnb by another host, another provider, who's maybe charging £100 a night, and you go off, I'm going to have to charge £100 a night. I've got to be competitive. There's other ways to be competitive, but that's typically where we see people going wrong with this. When you price based off what someone else is doing, you're relying on them having priced correctly. And in my experience, most people don't price correctly. So if they've gone in with a pricing that's under margined, well, now you're under margined unless you've kind of fluked having something slightly more efficient. So your costs will probably be totally different to what your competitors are. You'll have different suppliers, different efficiencies. You'll have a different way of doing things. So you maybe don't have as much wastage, or maybe you have more wastage than your competitor. And like I say, just copying them, you're just copying their problems if they've not done it correctly. So something that's really interesting is discounts. We see a lot of clients talk about discounts, offer discounts. They'll come straight out of profit. So if your margin's thin, well, a discount could just wipe that out. I always say, look, I've had instances where I've drafted an invoice and I've thought, oh, I might apply a discount. This is a really nice person, and typically we do. We try to be reasonable. But a lot of people go in thinking you've got a discount like 10, 20%. We'll apply discounts at maybe 2, 3% because we can't eat our margins. We've got to pay our staff. So we try not to apply discounts that are too high. You will still earn as much favor and goodwill with a client with a 2 or 3% discount as you would with a 10 or 15% discount. The fact that you've gone out of your way to offer a discount is enough. Don't offer a discount that's so high that it wipes out your margin. You'll do it for maybe 1 month and go, well, it's only one person. It will build. We see it all the time. So be a bit more conscious of that. Another thing is that more sales only help if your margin is healthy. And this is back into that turnover vanity that we talked about. If you don't have good cash timing, and good margins, then you just buy yourself more work, more stress. It's not worth the hassle. And then a sustainable price has to cover your direct costs, your overhead recovery, your owner paid target. And I use that term target very deliberately. Owner paid target, when you're running a business, you should be going with, what do I want to get out of this business? And if that answer is you want 3 grand a month, and that's where you want to get to, you need to be pricing for that. So you need to have that in the back of your mind whenever you're pricing your jobs, and a buffer. And a lot of people don't have a buffer. It's really important that you start to build a buffer because that's how you grow a company. So this is a method that we use with clients. So if we brought a client in and we did a workshop with them, and we've done this before, done it recently with a pizza company owner. That was actually quite a fun one. We came in, we took what makes up a pizza, and we basically reverse engineered the whole thing. It was brilliant because they actually came really well prepared with their costs and their supplier costs. But a really good method that will remove the guessing is just reverse engineering your price from what you actually need. So price from the outcome that you need, not from feelings, not from what you think the market will allow. It's obviously important what the market will allow, but to us, you price from the outcome that you need to achieve. So I would list You can see obviously down the left-hand side. I would list the costs that only happen when you do the work. So your materials, your subcontractors, the delivery, processing fees, they're your direct costs when we're working out that gross profit. And then work out what the business needs month to month to cover their overheads, then divide that by a realistic billable unit. Now, in services, we would usually recommend that you price based on hourly rates. So what you do is you get your direct costs, get your overheads, and then you fit them into an hourly rate. What's this hourly rate that I need to charge to cover all of these and make that profit that I want? But you could also charge based off days, or you can charge just based off individual jobs. So it could just change, job to job and be really honest about non-billable time, your admin time, your marketing time, your quoting time, delivery issues, reworks. A lot of people think, "Oh, I'm just going to quote this job and here's everything that relates to that job." But you've spent 3 hours marketing this type of service that you're offering. You need to be pricing for that. Otherwise, you've just worked for free. And remember, the whole concept of running a company is to get money out of the company to you for your lifestyle and how you want to live. So decide what you're paying yourself properly. And that means, what am I paying myself monthly? Not what can I just take at the end of the year. Add a buffer so that one bad month doesn't just come in and wipe you out. We aim for a 3 month buffer. We make sure we can cover all the wages, all the suppliers, everything for 3 months. And then if that price is above what the market will take, obviously don't ignore it. It's important that you don't just price based on the market, but you can't ignore it. Obviously, it's fundamental. You've got four options typically. You can improve the efficiency of how you run your business. You can reduce the costs to service the industry. You could change the offer. So you might be going, well, I'm going to do A, B, C, and C is the problem. So we can take C out. Or what we find is you just change who you're targeting. So if you're VAT registered, targeting non-VAT registered customers, well, you're instantly 20% above market price to everyone else who's not VAT registered. That doesn't mean your pricing's wrong and your business model's wrong. That means you need to start targeting people who are VAT registered, because then they disregard the VAT and all of a sudden you're now equally as competitive as someone who's not VAT registered. So what you don't want to do is just pretend that the numbers don't matter. You can see kind of a good example here of, if a job's £1,000, the direct cost for 300, your gross profit would be £700. This is what you should be aiming for, by the way, on £1,000 jobs. I know 45% net profit margin probably seems too high, but I've not accounted for a director's salary in this. We've lifted this from a client's account that's doing really well that we've worked with on this. So if they bill £1,000 for a job and the direct costs are 300, they'll make 700 quid. The overhead recovery was 250, their margin was 450. And then off that 450, they can pay themselves, they can pay HMRC. So they're what you need to be typically aiming for. I would suggest aim for 30%, 25 to 30% of a net profit margin in services. You could dip it down a little bit if you were doing the likes of, if you ran a bar. Most bars typically run a net profit margin 5 to 10%. It's not very profitable. But that's what you kind of need to be looking at. Those numbers on every job. Have a look at, put the job price in, put the direct costs in, put your gross profit in, overheads, what's your margin? Every single job. So cash flow is really important, because even a really profitable business can feel like it's constantly being squeezed with cash flow. Now, cash squeezes tend to happen because of timing gaps, not because you're bad at business. We've had that too when it happens. There are a few repeating reasons as to why you typically have a bad cash position. So the first and most obvious is due to late payers. I'm sure everyone has them. Okay, we have them. So this means you're actually funding work before you get paid. In your time, in paying for the costs, you're funding it. This probably makes up 80% of the cash flow issues that we see, being realistic. So you need to have a think, and you need to have a good think about how to handle this. It could be as simple as just not offering payment terms. We see this more and more now. So most people all often say, here's 7, 14, 30 days. We typically would say do payment on presentation. for everyone. And if someone specifically asks for some payment terms, offer 7, 14, 30. That might not be something you can do if you're dependent on your sector. People might need time. Could be extremely large projects and you want to drip feed it in. But typically, payment on presentation is the first way to weed that out. Because if they don't pay, you've probably not done all the work. It's very easy to stop yourself before you get into a hole. Or it can be managed with taking deposits. Typically, I like to advise that you take a payment on account or a deposit, which at least covers your VAT obligations, because HMRC will not wait around for their VAT payment. So typically and ideally, you want to make sure that you can at least cover that. And then one big one as well is due to growth. A lot of growth eats cash. If you want to pay new subcontractors, you want to market, it all adds up. You need to have a big cash reserve or a big capital injection before you implement any growth plans. So, and then finally, a return on corporate VAT and tax dates. So it's slightly different VAT to VAT bills and tax bills. Dates are really important when it comes to these things because your VAT date could fall just at a really bad recurring time because it's quarterly. Same with your corporation tax. One thing that people don't realize is that you can pick your VAT schedule and you can pick when you want your corporation tax to fall. Now you don't change it every year. Pick a date and stick with it, but you can change these, so that will make it a lot easier. So if you know your VAT falls in January or February, and I'll use service accommodation again, just because it's in my head. Typically, January and February are actually quite dull periods in service accommodation. So if you've got a VAT bill that's fallen in January or February, your cash strain is going to be a lot higher and it's going to be a lot of pressure. Now that is all alleviated with a tax pot. FYI, tax pots are brilliant. But if you don't have that luxury, you can change the dates and the reporting periods. So a really simple solution is to do an 8 to 12-week forecast, cash flow forecast. If you don't have a cash flow forecast, speak to us, email your account manager. We'll send you one that you can use. You don't need fancy software. We actually just use a spreadsheet. We actually use a spreadsheet for our personal ones as well as client ones. And the point isn't to have 100% accuracy. It's just an early warning system. So you want to see week to week when you fall into negatives. So some really quick actions that will move your cash flow is invoice faster. So I always like to operate with momentum. So once I do a job, I invoice the job because it's fresh in the client's head. It seems quite overkill. Some people go, "Oh, you're billing that a bit early." I like to just do it while it's there. I don't want someone waiting. I don't want to wait 3 weeks and someone forgets all the good work that I did for them. Shorten your payment terms. Set up some automated reminders. All systems have automated reminders. Use deposits if you're doing bigger projects as much as you can, and know when your big outflows are coming up. So know when your VAT, know when your tax bills are. Okay, you'll all be glad to hear, because I know we're throwing on a bit. I like to talk. Everyone always says I talk too much, Megan. But we're on to paying yourself. So pay yourself as a sole trader, pay yourself as a limited company, and then that's us done. So we have 3 slides left. So appreciate everyone hanging on. So we're getting these are kind of the stuff people are more interested in, and so we'll cover them now. But I would highly recommend the slides that we've just gone through should be the core takeaways, because if you just implement everything that we've gone through, you'll be able to pay yourself no problem. It's not going to be an issue. Paying yourself isn't the issue here. It all comes down to that gross profit margin and your net profit. So do genuinely focus on those. But as a sole trade, so we'll start with sole trades because it's the easiest one. Drawings are just taking cash out. They are not a wage. They do not reduce your taxable profit. Tax is driven by your net profit, not by how much you withdraw or personally spend. We've seen sole traders running payrolls. That's shocking advice. If you've got an accountant who's got you on your sole trade, you're running a payroll. It's not, and obviously, sorry, and you're not paying staff, you're paying just yourself, then it's actually not great advice for tax efficiency. People seem to think you need to. The only real way to get tax efficiency as a sole trader is actually a pension contribution, and even that is circumstantial. And so we'd always advise you speak to a financial advisor or speak to us about that. That will only get you tax relief though, it won't get you national insurance relief. So for sole traders, it's very, very simple. You set a consistent monthly amount which is we call it an owner pay amount, which is just your drawings that the business can actually afford to pay from its net profits, and then move a portion of that into your tax pot. So, 30%, for example, is a typical amount for a basic rate payer. As you go up the bands, that amount needs to increase. But as you go up the bands, you typically either start making pension contributions to cover tax bills and reduce them, or you move to a limited company. You should really only be in the basic rate as a sole trader or as a partnership. It's still kind of one of those positions where once you go into the higher rate, you really need to be moving to a limited company. Nothing's really changed in that aspect. So, really simple, set monthly payment, move it into your savings account. Don't get fancy with pay rules. It's not worth it. It's actually it's just not good advice. So, limited companies a lot more complicated, obviously, because the structure, and that structure matters. So company money isn't personal money. We all know that. As much as we like to think it isn't. It's not like sole trades. And that's why you always start as a sole trade, because it's easy. You earn money, that's your money. You do what you want with it. As a company, it's company money. So we need to be a bit more savvy with how we access it. First thing is salary. Okay, salary needs to be paid. It needs to be paid through a payroll or PAYE scheme. It's a cost to the company, give you tax relief, but it will give you regularity. Okay. It does come with admin and reporting requirements, but typically an accountant will do that for you. And then dividends are the other way. We want to extract money out of the business. Dividend distributions come to shareholders have to be supported, like I say, by distributable profits. It has not just profit, distributable profits. Best way to get your distributable amount for the record is just to work out what your net profit is, take the tax off, and that number is typically what's left. Now you can bring reserves in, but again, without getting complicated, that's typically a good indication. And how we structure all our clients is a combination of both. So it's a combination of both salary and dividends. So what I think, and I get asked all the time, by new clients signing up, what way should I pay myself? What I think a good pay structure actually looks like would be to pay salary via payroll on a very consistent schedule. At the minute, the number that I'm telling everyone is £1,047.50 per month as your salary. If that is all you can afford to pay yourself every month, or the number is less, they can only pay £800, then you do not need to add dividends into things. It's just going to complicate it. Don't add dividends in. Just do your salary until you're in a position where you can take more than £1,047.50 a month. Until that happens, don't think about dividends. You're only going to complicate it. Then when you're above that amount, we move to dividends. You should only declare dividends when you know there are sufficient profits. Regular bookkeeping is obviously what you need to do in order to figure that out. Typically use Xero or QuickBooks, and you need to document what you decide to pay yourself properly. Now, if you're one of my clients and you're on the webinar and you're thinking, I do not document what dividends I take, that's absolutely fine because Jonathan and I do it for you, so you don't need to worry. You want to try and avoid ad hoc withdrawals or taking dividends. And I use quotations because when profits aren't there, then you can't take a dividend. So you want to avoid taking dividends when there's no profit to do so, because that's when you create that director loan position. I'm sure a lot of people are familiar with that term, director loan. That's when that S455 tax kicks in the 34%, just under 34%. You don't want to be in that position, so you need to be very good and you need to manage it. That's typically then when people come to us and say, can you do the bookkeeping? Or they bring a bookkeeper in so that they make sure they don't fall into that trap. And so for limited companies, that is your most typical method. So it's salary of 1,047.50 per month. It's dividends on everything above that. And then what we like to do is throw in like mileage reimbursements, pension contributions as well. And there's other expense reimbursements, but they're all circumstantial and specific to each company. So it's not changed. It's not changed for a long time. It's always been salary and dividends. And it looks like it will be for the foreseeable future. So if that's what you're doing it right. All I would suggest you maybe do is add pension contributions in when you start to creep up above that basic rate, because there's no point paying higher rate tax unnecessarily unless you physically need the money to fund your lifestyle. But if you don't, but you still want to take the money out, pension contributions are great. So, last slide, I guess. So, the goal isn't to think about money every day. I think that's one way to have seriously poor mental health. Uh, the goal is to have one really calm, structured check-in each month, obviously, that keeps you ahead. That's what we do. We have a monthly SLT. We do just that. We look at the numbers. We make decisions as a group based on what those numbers are saying or what we interpret them to say. We do that on the same day every month, same order every time. So you can see that's actually our order. We've put it in. So we review the 5 line scoreboard that we went through. We check our VAT pots, our tax pots. We compare against upcoming deadlines, make sure we haven't missed anything. We look at our forecast. I've obviously put 8 to 12 in. We run a 12-month cash flow forecast. We look at that and we choose one decision for next month on something that we want to try. We don't go and choose 10, we don't choose 15. We choose one thing and we try and implement it and we see what way that changes, what way that impacts things. I would recommend that you get support when the cost of a mistake is high. So if there's VAT involvement, there's payroll involvement, or there's dividends or direct or loan involvement, then I would recommend that you get professional support from an accountant. Maybe if you're pricing and you're not confident that it's correct, or you're growing and you want help making decisions. Jonathan and I, we're licensed in it. We sat exams in business studies and how to grow businesses and how to interpret what businesses are doing. It was part of our ACCA qualifications. So we feel very confident doing that when other people necessarily don't. So always feel free to reach out. If you want to know a specific to you, what is the most reliable way to pay yourself? Again, that's when you would want to reach out because we have to interpret numbers. And again, if you don't feel confident doing that, we can. So to us, good support isn't about these fancy reports. Plenty of accountants out there got these lovely Excel sheets. They're really good. They look all colorful and wonderful. We just like to give you a clear answer. I'm sure everyone who's worked with us long enough knows. Here's the answer. This is what you do. There's no fancy reporting about it. So Megan did ask me to try and summarize this webinar in one go, but it's been 54 minutes and quite a lot has happened. So I'm not too sure how I'm going to summarize it into one word. But I would say it's going to be that the control over your finances is going to come from separating your money, knowing your margins and forecasting. Separating your money is so important. Tax pots alone would have saved 80, like I say, 80% of my clients a headache. So really, I do encourage that you do them. You must know your numbers. If you're running a business and you're the best hairdresser, or you're the best tradesman, or you're the best plumber, or you drive your taxi the best, that's all well and good. But if your numbers are wrong, your business will tank. So it doesn't matter how good you are. We say this all the time. They're great at what they do, but they don't know how to run a business, and that's really important. You've got to understand your numbers to do this. So I guess before we wrap up, obviously I want to extend a thank you to everyone for coming out. This is your evening. I really appreciate your time, your attention. I think we've covered the importance of actually knowing your numbers, and why it's really important, why it's vital. If you have any questions or you need specific help, please don't hesitate to reach out. Like I say, I love you, our clients. You've got our direct booking links.